How finance drives climate change. At the annual United Nations climate conferences, the nations of the world have committed to becoming carbon neutral by 2050, but many question whether the world's government's actions are matching that commitment. The energy we use, electricity, heating and transport, accounts for around 2/3 of global greenhouse gas emissions. 81% of the global energy mix is still based on fossil fuels, the same percentage as 30 years ago. I'm telling you this because finance is a key driver of climate change. Perhaps it's the most important driver. Where the people and institutions of the world invest their capital has a significant impact on the environment and climate, as well as on society everywhere. The dilemma is that all commercial decisions are driven by their financing. Businesses and householders want cheap energy, and that drives investment in fossil fuel extraction. People want affordable food, and that drives intensive farming and the destruction of ecosystems. Businesses want resources, but extracting those resources drives environmental damage. And we all want to improve our standard of living. But in a finite world, there is a limit to the extent that that is possible. Economic activity drives climate change, but the power of finance can also be part of the solution. And this is where green finance and ethical investment come in. So what is green finance? 3 drivers of green finance and ethical investment. As we see, the world of finance drives climate, environmental and social change. Where investors only care about returns, projects that negatively affect the environment prosper. And there are many such projects and investors. Oil and gas investments continue to expand. Deforestation remains significant. Mineral extraction continues apace. And some nations are considering allowing deep-sea mining. In spite of all the evidence, some people refuse to believe in climate change or are only concerned about profit. Weak regulation and politicians concerned only with power exacerbate the situation, and I do not necessarily criticize such mindsets. Change is scary, and many people are concerned about the costs of change in a world where financial inequalities have got worse in the last 40 years. Ethical, environmentally sensitive projects need to be affordable and practical. But the evidence of climate impacts is making a difference. Mindsets have changed a great deal in the last 10 years, and this change in thinking brings us to the 3 drivers of green finance and ethical investment. First, we have consumer sentiment. Many of us pay into pension plans, and we may have savings products of various sorts. Increasingly, we the public are demanding that the investment management firms that hold our funds invest ethically. Consequently, the number of ethical investment products and environmental, social and governance, that's ESG, funds available has grown tremendously. We'll come on to the rating systems used to identify funds as ethical later, but according to the Harvard Business Review, $2.7 trillion of assets under management was held in so-called ESG investment criteria in 2022, and this is growing at over $500 billion per year. Second, we have the rise of corporate social responsibility. Organizations are run by people with families that care about climate change and environmental damage. Social and environmental responsibility has risen up the corporate priority list for senior management and corporate boards in recent years. In many organizations, corporate responsibility is as important as providing a good return for shareholders, although the 2 priorities are not always in harmony. There are many reasons for this increase in the profile of environmental, social and governance factors. Governments and regulators are forcing change. Consumers are becoming increasingly determined to avoid purchasing from companies with poor records, and management teams themselves are wanting their organizations to contribute to making a difference, which, of course, means that their investment plans should at least avoid projects with negative environmental and social impacts, and may even contribute to positive impacts. Lastly, we have governments and regulation. The Paris Agreement Treaty on Climate Change was adopted in 2015, and now has 195 United Nations member states signatories. The Paris Agreement covers climate change mitigation, adaptation and finance. In terms of finance, the agreement requires signatories to ensure, quote, finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development, end quote. The Paris Agreement has led to binding legislation and regulation in member states. We'll cover the main frameworks that relate to ethical investment later in the course, including international standards for green finance, corporate disclosure requirements, and so on. The real-world impacts of climate change, coupled with the increasing focus of populations and governments on environmental, social and governance issues, has propelled green finance and ethical investment to the forefront of many agendas. So now let us explore some definitions more closely.